15 years, investors had one giant safety net, the Fed. Every time markets broke, the Federal Reserve stepped in with lower rates, more liquidity, and more money printing. Now that era might be ending because the new Fed chair, Kevin Warsh, wants a smaller Fed, less market intervention, and far less support for financial assets than prior Federal Reserve regimens. If he succeeds, the investing playbook that has worked really well since 2009 might not be as effective moving forward, and most investors are completely unprepared for that shift. This is not really about the next rate cut. It's about regimen change. That shift matters more than any single interest rate decision. The CREF, otherwise known as the Fed cut, might be going away. And so in this video, we're going to cover why that is such a big deal. We're going to talk about what changes are coming, what stays the same, and the one mistake that most investors are likely to make if they don't factor this into their portfolio decisions. Okay, for 15 years, the Fed trained investors to lean on mountains of cheap money and constant support in financial markets. That taught investors to always buy with dip. Markets moved on Fed guidance and signals as much as on real fundamentals. Pricing got distorted across almost every asset class due to all that, quote, free money and quantitative easing. Now, Warsh wants to end the free money experiment. He has called for regimen change at the Fed. He wants the central bank to be smaller, quieter, and less of the market manipulate. He wants fewer artificial tailwinds for growth at all cost assets. In other words, this is a shift away from liquidity-driven markets and toward cash flow-driven returns. Why is that? Because if interest rates are higher for longer, you can't make as many bets on things that may or may not work out, and you have to invest in things that are producing cash flow. And that's why for anybody building durable income for their retirement, this is the headline, not the next rate move. Now, also interesting is Warsh doesn't worship inflation data either. His read is that the Fed keeps fighting the last inflation war, which is why the Fed has handled inflation post-COVID so poorly. Too much free money at COVID, too late to tighten, then late to ease, and he created lagging numbers like shelter inflation, which still pushes the inflation rate higher, even though rents have been flat to down for years. In the world of AI, the Fed is still using human surveys to try to gauge inflation pricing data. This is ridiculous, right? It leads to bad delayed data and poor decision making. There is too much human judgment involved in that process. That is likely going to create room to reduce rate. Now, I agree that will probably happen eventually, but the picture for now has changed. The war has caused oil prices to jump. Gas prices are obviously higher than they have been, and the latest inflation reports are coming in a bit hot. And so the AI disinflation story has been put on hold, and the case for lower rates is now being contested. Warsh is inheriting a much further hand than the one he was expecting to inherit just a few months ago. Now, I want to be clear about one thing. I do not forecast markets, inflation, or interest rates. I don't think anybody can. And anybody trying to tell you otherwise is either an amateur or is being dishonest. These things could turn on a dime. So instead, I handicap. My grandfather would smile at me, admitting as much because he loved to bet on the ponies. Now, I prefer income investments over betting on horses at the racetrack, but it doesn't change the fact that great investing is really great handicapping. You're trying to put your money in a diversified portfolio of investments that, based on the probability of those investments doing well, based on what other people are willing to pay for them, how much then are you going to get in return? It's handicapping. So the job is not to forecast rates or obsess over the Fed, but still we can't ignore these things because you need to know what the playing conditions are on the field when you're making investments. Plus, we focus on income investing, so base rates really matter. The Fed funds rate is financial gravity. It's the numbers professionals use to price all other financial assets. So no, we don't predict, but we do listen and we handicap. Based on what he's saying, we think he's going to focus on three differences at the Fed. First, a change in how inflation is measured. So we're talking about CPI and PCE. Warsh wants to cut off the more dramatic tail reads and smooth that data. Right now, we're seeing these numbers spike dramatically because of the war in Iran, which hopefully ends relatively soon. Warsh believes that the Fed really responding to those temporary spikes has led to a giant fatal policy error. In other words, we're overreacting to short-term numbers. Therefore, he wants to use trimmed averages, which is going to remove the temporary noise in the data. This reduces the extreme statistical outliers, and he also wants to remove what he believes is an arbitrary 2% inflation goal. So we actually don't know what inflation rate he thinks is excessive, but he mostly just wants inflation to fade off into the background and get it out of the headlines. Now, this could give him some cover to lower short-term rates just a little bit, not dramatically, as it's highly unlikely we're going back to zero interest rates, but enough to steepen the yield curve. In other words, the longer duration bonds, the 20, 30-year bonds. He wants those to remain higher, and he wants the short end of the curve to go a little bit lower. Okay, number two, we'd like to push mortgage-backed securities off of the Fed's balance sheet. The Fed has been buying mortgage-backed securities, MBS bonds, in order to help support the housing market. And we'll see if he does this, but that is going to likely put some upward pressure on 30-year mortgage yields. I'm a little bit less convinced that they're going to pursue this in the near term, given where mortgage rates are today. We've already seen them spike recently due to the war, and the housing market remains still a bit frozen. All right, number three. I think this Fed is going to lean on the AI productivity story a fair amount. I think they're going to look through the numbers a little bit on the AI productivity boost in a way to offset some of the near-term inflation numbers that they're seeing. Because honestly, Warsh knows that Congress is never going to actually deal with our current debt of $38 trillion or probably $39 trillion by the time this video ends. Our politicians aren't suddenly going to get courage and pass austerity measures. Therefore, we have to deal with the government debt the old-fashioned way. We're going to slowly inflate it away, basically by debasing the currency, which is awful, and it's something that we as investors need to watch meticulously because we don't want to erode our purchasing power, as that's an incredibly easy way to lose wealth over time in retirement. Okay, that's great, but where are we at right now? Well, the interest rate curve is starting to reflect what Warsh actually wants. Short rates have drifted down, long rates have ticked up a bit and are remaining quite high. It's reflecting the real cost of money, ensuring that we have a real economy, not a fake, artificially Fed-inflated economy. Once again, I think this is the direction that the Fed chair wants now. He wants the Fed to stop being a celebrity today and step back behind the curtain. Now, assuming that happens, this is what it means for income investors. If short rates continue to drift lower, cash and T-bills are going to be less compelling, of course. Sure, they're safe, but they're quietly going to lose ground to inflation over time. A pile of cash is not a strategy. Sure, we want to hold enough cash to get through 1 to 2 years of our lifestyle expenses, but if you're just holding cash, you're really deciding to wait, and waiting is expensive in an inflationary world. Don't confuse lower short-term rates with the return of easy money. Deep down, Warsh leans a bit hawkish, not dovish. In other words, he hates the idea of massive money printing. We'll see, but he seems to have a rate floor that he's just not going to go under because he wants a smaller Fed balance sheet. That means the Fed put and the growth at all cost era are highly unlikely to return, which could mean more volatility in the stock market. The market has been unusually calm this cycle, but if the last 100 years of market data has told us anything, it's that markets don't remain calm forever. That doesn't mean the market's going to crash, it just means that it's unlikely to be as calm and as smooth of a ride as it has been this last cycle. Lastly, if inflation stays elevated and therefore long-term rates stay high, hard assets with real contractual cash flow are well positioned. Companies and assets that have pricing power, especially, which could grow cash flow faster than inflation, are going to outperform. And that's exactly the type of investment that we want to focus on. Now, this resonant change of the Fed might sound a little unnerving, but honestly, a quieter Fed is a breath of fresh air. Less signaling, less liquidity-driven distortion, more honest pricing, more investors that own real cash-flowing assets. I think the world and the markets are a healthier place because things get extremely simple. Hard assets with pricing power that can fund a retirement based on real dollars as opposed to hope, and giant market multiples based on sales revenues as opposed to profits. That is a healthy market. That leads to durable cash flow that investors can count on long term. And I think the investors that don't acknowledge this change are about to make a mistake. They're going to keep running the same playbook from the last 15 years, which net growth at any price at really high multiples and putting the multiple on sales as opposed to profits. And I think that the people that are just sitting waiting to deploy more capital in that same strategy are going to miss the new resonant change that the Fed is now pushing. We think the better move is actually boring and fairly repeatable. Build income. You don't have to worry about what entry multiple as much as you just need to worry about are these assets producing cash flow. Get paid fairly for every risk you take and take risk off the table by taking that cash flow over time. Own assets that can get you through a bad year without flinching. Those tend to be my favorite kind of assets because you can hold them indefinitely, ideally forever. But I do know which kind of portfolio that historically has held up great either way. And you want to see how we build those kind of income portfolios, they'll link just below. Thanks for watching.